Hi friends, welcome back to Murthy Finance Academy. Today we will discuss some key players from solar energy sector. So the first company which we are going to discuss today is Waaree Energies. So Waaree Energies delivered a powerhouse Q3 fiscal year 2026. Revenue surged to 7,565 crores, which is 118.8% year-on-year growth, and operating EBITDA also hit 1928 crores with 167.2% year on year, and PAT climbed to 1106 crores with 118.4% year on year growth. Operational velocity is relentless, evidenced by the commissioning of 5.1 gigawatt of new capacity and a $30 million strategic investment in Omani polysilicon to insulate the supply chain from Chinese volatility. The critical strategic question: can Waaree scale its US manufacturing footprint fast enough to outrun the Department of Commerce 126% tariff hammer without diluting its industry leading margins? So, solar manufacturing has graduated from a commodity business to a high stakes geopolitical chess piece. As the West attempts to decouple from the China plus one dependency, Indian incumbents like Waaree Energies, Premier Energies, and Adani's Mundra solar plant have become the primary non China alternatives for US developers. However, this prominence is a double edged sword. While it fills the order book, it also places Waaree directly in the crosshairs of Southeast Asian incumbents fighting anti-circumvention duties. Waaree is effectively a leveraged bet on US regulatory endurance. Its positioning as a non-China alternative is its greatest asset, providing a silicon shield of bankability that competitors in Malaysia and Vietnam are losing. Yet, the same visibility makes Waaree a target. Success depends on shifting from a pure exporter to a localized US producer while aggressively backward integrating to eliminate cell sourcing risk. So, the company incorporated in 1990 and headquartered in Mumbai, Waaree Energies is now India's dominant solar force. It commands a 21% domestic market share and an outsized 44% share of India's solar exports. The firm has delivered an absolute masterclass in capital scaling, yielding a 2700% return profile since its pivot to massive scale. The current 23 gigawatt module capacity is only the baseline. The Waaree 2.0 roadmap targets 10 gigawatt of fully integrated ingot and wafer capacity to complete the value chain. So Barry's advantage isn't just the 5.4 gigawatt cell capacity, it's a 1.5 decade lead in US bankability and certification, a process that takes laggards 4 to 5 years to replicate. Domestically, their ground game is unmatched with 580 plus retail stores and 4,000 plus distribution points. This retail engine creates a price agnostic buffer that protects margins when utility scale pricing enters a race to the bottom. So the investment thesis is evolving from module assembly to a fully integrated energy titan. By moving backward into cells, wafers, and polysilicon by the United Solar holding investment in Oman, Waaree is fundamentally re-engineering its unit economics to capture the entire margin stake. The market is currently missing the silicon shield of traceability. Under the US Foreign Entity of Concern FEOC rules, the origin of the silicon is the only thing that matters. So, Waaree's 30 million Omani investment secures a 100K TPA silicon plant, ensuring that their supply chain remains clean of Chinese influence. This integration doesn't just expand margins, it acts as a regulatory insurance policy that bypasses the 126% tariff aimed at India made cells. So the company's TAM is being redefined by the AI power war. US annual consumption is expected to hit 70 to 80 gigawatt with a massive 3-year pipeline of 180 to 200 gigawatt. In India, the 100 plus gigawatt module capacity outlook is underpinned by the RDSS scheme and strict FEOC rules. Energy security and data localization are the new primary drivers of Make in India. US buyers are increasingly forced to pay premium for clean supply chains. Waaree is the primary beneficiary of this bifurcated market where FEOC compliant products command a significant price premium over the cheaper but duty exposed Southeast Asian alternatives. So the company's overseas exports and US manufacturing nearly contributed to 30 to 35% of revenue. The high margin engine fueled by a 25 gigawatt plus specific export order book. Coming to its retail segment, it generated nearly 20 to 25% of the revenue. It is price agnostic segment yielding a 1 to 1.5 cent premium per panel over utility pricing. Coming to EPC and O&M segment, 18 to 20% of revenue it contributes, and it is a service heavy with high barriers to entry based on project qualification. Coming to its self manufacturing, 5.4 gigawatt is the current capacity, while it is expanding to 15 gigawatt to capture the 126% duty protected domestic demand. Coming to inverters, it is having 4 gigawatt planned, and its phase 1, which is of 3 gigawatt, is already commissioned, with phase 2 1 gigawatt slated for fiscal year 2027. And its Arizona HJT facility acquired for just 20 million. This 1 gigawatt line was secured at a significantly lower cost than the Texas facility, proving management's capital allocation efficiency. And coming to battery energy storage system BESS, it is planned for 10,000 crore planned capex for 20 gigawatt hour, targeting the next leg of the energy transition. Coming to transformers, it is having 20,000 MVA capacity, strategically positioned to fill the supply gap in the 3 lakh plus crore RDSS scheme. So the company generated nearly 7,565 crores revenue. Volume was the primary driver with 3.6 gigawatt modules sold in a single quarter. So margins also improved to 25.5% of EBITDA. This represents quality expansion as cell integration begins to lower blended input costs. And coming to balance sheet, borrowings also hit 2,941 crores in September 2025. Debt is rising to fund the massive 25,000 crore capex cycle, but asset efficiency remains high. Coming to earnings trajectory, the PAT reached 1,106 crores. Annualized ROCE stands at 40% and ROE at 36.8% based on this record Q3, notably outperforming the trailing 12 months ROCE of 34.9% seen in earlier. So management has proactively made a provision in the previous quarter to cover potential financial impacts from US investigation into cell sourcing, showing high disclosure standards. So Waaree's earnings are top tier quality. Growth is volume led, up 35% quarter on quarter, and the 40% annualized ROCE proves management isn't just spending money, they are generating massive returns on that capex. So this is industrial scaling at its most efficient. So coming to some con call highlights, they have asked related to 126% of the duties using India-based cells. So management has bypassed the 126% wall by sourcing cells from neutral territories for their US exports since 2019, long before the current duties were announced. So the company is having jurisdiction expansion between the US requires full traceability. So the company is sourcing cells from jurisdiction which are about 10%. So it was 19% also, but moving more towards the 10% regions. So this confirms a proactive strategy to migrate supply chains to lower tariff regions ahead of regulatory shifts. And US is going to more emphasis on the FEOC compliance. So Waaree's strategy of fully integrating supply chain up to polysilicon will start showing its impact by April 2026. So management is selling compliance, not just panels. They're ready for the April 2026 FEOC cliff that will break competitors. The power demand driven by the AAs and AA war, which is happening all across, we are falling off our own manufacturing supply. So this means that this highlights that the biggest risk is in demand, but the speed of supply ramp up to meet data center requirements. And its strong order book gives us the right to win in the entire supply chain wars. So here scale acts as its own mode. Suppliers prioritize Waaree, ensuring that they get clean silicon that others cannot secure. So the company's contract with customers allow us to even pass through if at all there is any impact. So this de-risks the P&L from future tariff shocks as contracts have built-in protective clauses. So management demonstrated exceptional foresight by sourcing from neutral jurisdictions since 2019 and building pass-through clauses into contracts. They have effectively neutralized the 126% duty threat. They can be trusted to navigate US volatility. Coming to its order book, it is having a nearly 60,000 crore of order book, which is net of dispatches, and module sales of 3.6 gigawatt in Q3 alone. and production velocity of 52 modules produced per minute, which is 1 gigawatt plus per month, and its asset efficiency cash conversion cycle is at 35 days as per March 2025, a massive improvement from 66 days in 2023. Coming to returns, it is having 40% ROCE and 36.8% ROE on an annualized Q3 performance basis. So currently, the Waaree is trading at nearly 21.7 times price to earnings multiple, implies a tariff discount that backward integration into Oman and Texas is rendering obsolete. At a 75,601 crores capex market cap, it trades at a discount to APAR Industries 42.1 times and is in line with Premier Energies 24.6 times of the PE. So in a bear case scenario with 15 times PE, US tariffs expand to neutral sourcing, Arizona and Texas ramp up delayed, and 100 basis points margin contraction. In a base case scenario, we can expect the PE to be around 22 to 25 if the US capacity hits 4.2 gigawatt on time and Oman polysilicon commercializes in Q1 fiscal 2027. In a bull case scenario, we can expect 30 times of the PE with full ingot and wafer integration expands margins to 28% plus, and Waaree becomes the non-China solar standard for US big tech. So at 21 point times current PE, the stock is undervalued for its 129% TTM profit growth. The market is pricing in headline risk while the integration reality controlling the silicon itself is being ignored. So what some important risks in this company which I have observed is the 126% shock. While currently not applicable, any narrowing of the neutral sourcing definition by US regulators would be a headwind. And risk impact math, 100 basis points means 1% EBITDA margin contraction on TTM revenue of 22,060 crores represents a 220 crore hit to the bottom line before taxes. And capex executing a 25,000 crore outlay is a massive undertaking. Delays in the Arizona HJT line or the Oman pilot could drag on ROCE. Next is technology pivot. The shift from TopCon to HJT is accelerating. Waaree's 20 million Arizona HJT acquisition is a good start, but obsolescence remains a 100 to 200 basis points margin risk. Coming to key monitorables which we need to track is Texas 1.6 gigawatt facility, Oman polysilicon facility, and Arizona 1 gigawatt HJT line, and its net debt trajectory and FEOC enforcement. So Waaree Energies is no longer a simple module manufacturer. It is a regulatory mode play. The bull case rests on the fact that Waaree is one of the only global players capable of providing a fully traceable non-Chinese supply chain at a 20 gigawatt plus scale. While the 126% tariff headline is terrifying to the uninitiated, the company is sourcing from neutral jurisdiction and its rapid $30 million move into Omani polysilicon build a resilient silicon shield. The market is likely overestimating the immediate tariff risk and significantly underestimating the competitive advantage of Waaree's 1.5 decade US bankability lead. If the 4.2 gigawatt US capacity milestone is hit by mid current year 2026, the current valuation will look like a bargain. Hope you like this video. If you do like this video, please do like, share and subscribe to Mutthi Finance Academy. Thank you.